Turn on the news this week and you'll hear two headlines. The Fed is preparing to cut rates. Maybe borrowing is about to get cheap again. And America's biggest companies are spending billions on mergers. Maybe the boom is back. But both of those takes miss the bigger story. Because the real risk isn't just who's merging with who. It's the trillions of dollars of debt underwriting the entire cycle. Today on Global Notes, I'll take you past the headlines and show you the one signal that shows up in every single crash: corporate leverage. Let's rewind the tape. In the 1980s, junk bonds fueled a takeover boom. Debt piled up. When Volcker raised rates to kill inflation, defaults spiked in the 1990-91 recession. In the dot-com bubble of 2000, telecoms borrowed billions to lay fiber networks. Debt to GDP hit cycle highs. When the bubble burst, earnings collapsed, and leverage ratios exploded. In 2008, companies were borrowing aggressively for buybacks and mega buyouts. On the surface, it looked fine. But when profits dropped 30%, debt to EBITDA jumped, credit spreads blew out to 2,000 basis points, and defaults hit 12%. And in 2020, the pandemic shut the economy overnight. Corporate debt hit 81% of GDP. Earnings evaporated. For a moment, leverage ratios were off the charts. The Fed had to step in to stop a wave of bankruptcies. Every time, the story is the same. Leverage rises quietly in good times, and then it explodes when earnings fall. So where are we today? U.S. corporate debt is again at record highs. More than $8.5 trillion, about 75% of GDP. Many companies refinanced cheaply in 2020 and 2021, pushing their maturities into 2026. That bought time, but not safety. And here's the kicker: credit spreads are still near historic lows. High-yield bonds only pay a few percentage points above treasuries. Investors are acting like leverage doesn't matter. But history says that's when it matters most. The real signal isn't just leverage. It's the gap between leverage and spreads. When leverage is high but spreads are wide, risk is already priced in. But when leverage is high and spreads are tight, that's complacency. And complacency breaks fast. In 2007, spreads were calm right before defaults surged. In 2019, spreads were calm until the pandemic forced the Fed to intervene. We're in the same setup again. The question isn't whether leverage matters. It's when spreads wake up to the risk. The lesson is simple. Corporate leverage doesn't cause every crash, but it decides how bad every crash will be. And right now, U.S. companies are borrowing again to fund a trillion-dollar wave of mergers. That may extend the boom, but it also makes the next downturn sharper. So if you want to know where the economy is heading, don't just watch the Fed or GDP, watch leverage. And especially watch credit spreads, because every crash may have a different trigger. But they all share the same signal. If you found this useful, hit like so more people see it. Leave a comment with your take on whether corporate debt is the real bubble. Share this with a friend who only watches stock charts but forgets about credit. And don't forget to subscribe. On Global Notes, we go past the headlines to show you the macro signals the media always misses. This is Global Notes by JP. See you in the next one.